Today on Forbes, why AI stocks are giving some investors dot-com bubble déjà vu. At the end of the 1990s, there was one narrative on every stockbroker's lips. The so-called World Wide Web would change everything about our way of life, the way we buy and sell goods, interact with friends, conduct research, and advance our careers. It would be impossible to imagine life without it. That narrative has come true on a scale beyond what many imagined, but it might not feel that way for the investors who bought into the craze. First, there was the crash in March 2000, which ultimately took the stock market down 49%. Even worse, had you held on to the 10 largest tech stocks by market capitalization from the beginning of 2000, all 10 would have lagged the S&P 500 by the end of 2015. Fast forward to today, and the only stocks that have pulled ahead of the broader market in that quarter-century span are Microsoft and Oracle. The rest, names like Cisco, Intel, Qualcomm, and IBM, have sorely disappointed investors. It's a cautionary tale for today's investors, who have bid prices up on the belief that artificial intelligence will revolutionize the world the same way the internet did. The information technology sector makes up more than 33% of the S&P 500 index, matching the levels of the dot-com bubble of the late 1990s. Semiconductor designer NVIDIA alone makes up 8% of the index thanks to its $4.3 trillion market cap, up tenfold in 3 years. But even if AI is as transformative as most expect, the stocks that have been the biggest beneficiaries thus far may not be winners in the coming decades. Rob Arnott, founder and chairman of Newport Beach, California-based investment advisor Research Affiliates, says, quote, "It's important to distinguish between the stocks and the companies. These are great companies with great products. Bubbles burst not because the story is completely wrong, but because around the margins the story is wrong. The story of the rate of growth, the time horizon of growth, is unrealistically optimistic, and the risk of competition eroding market share is underestimated." The S&P 500 is priced at about 30 times earnings today, significantly more expensive than the typical historical average of around 20. The Nasdaq 100 currently has a PE, or price-to-earnings ratio, of 33. At the peak of the dot-com bubble in early 2000, the S&P 500 had a multiple of 34, and the Nasdaq 100 had one over 70. Most of that premium this year has been driven by tech stocks, which are trading at 41 times earnings and nearly 10 times sales as a group in the S&P 500. NVIDIA's PE multiple is 57, and it's worth 29 times its $148.5 billion in 12-month sales. Chipmaker Broadcom, which has gained more than 400% since the start of 2023 to surpass a $1 trillion market cap, is priced at 110 times earnings. The valuations are more baffling for some smaller companies. Shares of Palantir Technologies, which makes software for data mining, have exploded by 2,400% since the start of 2023. Its business has grown to $3.4 billion in sales in the last 12 months, up 39% year over year, and it has become profitable, but its market value is now more than 100 times that revenue figure. Advanced Micro Devices, another chipmaker that's risen 100-fold in the last decade, is priced at 97 times earnings. Those premiums have continued rising throughout the summer. The S&P 500 is up 30% since April 8th, making a 19% tariff-induced plunge earlier in the year a mere blip and quickly reaching new record highs. The Global X Artificial Intelligence and Technology ETF is up 43% in that span. A generation of investors has been taught to, quote, "buy the dip" at any sign of trouble and been rewarded for that confidence for 16 years. So despite anxiety over tariffs, inflation, and a weakening job market, money keeps flowing in. Jim Stack, president and founder of InvestTech Research, says, quote, "In the early stages, it's driven by FOMO, a fear of missing out. But as the bubble matures, it's basically a nervous complacency that pulls people into the market. It's not like they're expecting big gains, but they just can't stand not to be in it." For full coverage, check out Hank Tucker's piece on forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.